Well, hello everyone. Don Garman again here, another month, May of 2023. Obviously here from Mirador Capital Partners. Wanted to just check in and share a few thoughts with you on this all-important Fed day, where certainly the market is anticipating we'll get another 25 basis point hike. Wanted to address a couple things up front. Obviously, this has been a tumultuous 6 weeks with Silicon Valley Bank. And then just this week, First Republic Bank, again, another bank that's been in business for, I think, 46 years or 48 years or something, through all kinds of different economic conditions and crises, having been seized and liquidated, and the stockholders lost all their money, and the bondholders lost all their money, and the preferred stockholders lost all their money, all the things that in some form or fashion really haven't been the case so far. And yesterday was another example of the pitchfork mob going after other regional banks, and an attempt to flush out who's next and who's weakest. And so it raised a couple questions about Schwab. I wanted to address those up front and explain what I believe to be the differences, the important key differences, and where the relative positioning is. So the first thing to consider is people don't really consider Schwab a bank in the same way that they consider regional banks, where you would go to finance a shopping center or finance a condo project or finance a strip mall that you wanted to develop. Schwab is a different kind of bank. It is a bank. And in fact, my family and many of our clients do all of their banking here. But it is not the place where you would go to borrow money to, develop a real estate project or a, condo complex or a bridge or something like that, right? Those are very long duration type projects. And so it brings up another thing I wanted to discuss, which is somebody asked, can you simply explain sort of what happened to Silicon Valley Bank and what is this issue that what is this kink in the hose that we are currently in the midst of? What created it? So I think that we can look back even over the last couple of years. If you've watched these regularly, you would remember a little under 2 years ago, in the fall of 2021, I did a video about locking in long-term interest rates. It was the last time I myself, my family, got a mortgage, where we got a 30-year mortgage for sub 3%. So many of you did the same. I remember dishing out, referrals left and right to the people we use to get those type of loans. And that was the major activity in the fall of 2021. Markets were going great. Interest rates were super low. You could get 30-year fixed rate loans for sub 3, and many of us did. So let's think about the backside of that transaction, which is that money did get funded from somewhere. So either those get funded from a bank's balance sheet or an insurance company's balance sheet or a security that gets packaged up with other loans like that and then sold to someone else. So those securities exist in the world. Well, those securities have gone down a lot in value, as all fixed income instruments do as rates rise. So all of that has gone down in value. And one of the things we did very right last year is we missed that flaming spear of fixed income obliteration that happened all over the place. So, but not everybody missed it, because everybody can't miss it. So it hit a lot of people real hard. And obviously many of those loans ended up, if you took those deposits as a banker and you bought longer bonds or you financed homes for 30 years at fixed rates, and interest rates go up 9 times in a year like they did last year, you're holding large losses on your balance sheet. And in their attempt to replace some of that capital, they spooked their depositors and people started pulling money. And now it's easier than ever to pull money. And so that created, in essence, a run. And then that sort of led into banks like it which is in similar enough in First Republic's case. How is Schwab different? So Schwab loans money against your portfolio, your stocks and your bonds. And so, and it's hard to overstate this. Schwab is many, many, many times larger than everybody else that has been discussed. In fact, by client assets, I looked this morning, almost 40% larger than Morgan Stanley. So it's not thought of in that way. But Schwab is a massive, massive, massive company. So and 86% of the deposits held at Schwab are under the FDIC limits as it is. So to say that there is minimal exposure at the deposit level at Schwab is in reality, in my opinion, of course, a massive understatement. Am I concerned? Not in the slightest. Am I concerned about every other thing? You bet. I have got a long list of concerns, not the least of which is the debt ceiling coming up, the fact that the government could run out of money as soon as June. And last time that happened, obviously the markets did not enjoy that. And the other thing is, with rates up this high in the short term and lower in the long term, I want everybody to think through for a second the incentive shift, which is it now no longer makes a ton of sense to put your money out or lock it up for 10 years in US Treasuries at 3.5 when you can get 5% for 18 months. So as asset holders, that is one thing. So we can lock our money up for 18 months and take our chances that, we'll be able to reinvest that in 18 months at the same kind of rates. But for the economy, that's not necessarily a good thing. There is a principle, it's like a law of gravity called the time value of money, which means that the longer you are willing to go without liquidity and put your money somewhere, the more return you ought to expect to receive. So it's once again, the kind of teeter-totter has now banged against the ground in the other direction, almost, from where it was 2 years ago, from one side to the other. And I'll go back yet to another metaphor I used a couple of years ago during COVID, which is the policies that were being enacted were equivalent to the adrenaline shot to the heart of a heart attack patient. So first, shut the economy down, shoot the adrenaline in. Let's make sure the patient is gonna survive. Well, now we are in this painful process of recovery and trying to get back to a normalized lifestyle condition. And, we've talked about bullwhips and we've talked about adrenaline to the heart. We've talked about turbulence. And so I'm going to leave this video on this thought, which I talked a little bit about last month also. We don't have to be aggressive at all points along the way. We don't have to play every hand or swing at every pitch, or, we don't have to treat all conditions like they're the same. And I think there's this feeling that, what are we going to do to go back and get back to where blah, blah, blah. And how are we going to get into the hot thing that's going to be great? And there will be time for that. There always will be another bull market ahead, and we will be participants in it. The key between now and then is you can't be all in or all out. So we have to own the things that we have high conviction in. That for me is the highest quality businesses run by the highest quality management teams at what we regard as reasonable prices. So as you can tell, we don't zip in, zip out, all in, all out. Sometimes it's okay to just keep, fold a hand and let another month pass and kind of stay balls of your feet and very balanced. That is how I regard our current position. That is certainly the position we will stay in as we near yet another, binary event where they're going to play chicken with the U.S. government credit rating, and I'm all in favor of cost cutting. at the government level. I'm completely in favor of it. I just wish there was a mechanism to get behind a closed door and agree that cuts are warranted, and cut a little over here and cut a little over there, and everybody feels a little bit of pain, and then we can kind of get to a more rational position. That, of course, is my utopian answer, but I doubt that's the way we're going to resolve this. So until it is resolved and behind us, I think it's okay to just sort of, stay in the center of the teeter-totter and not get banged around on either side, which is kind of how we've been for a while and how we will continue to be for the foreseeable future. So I will leave it there. Don't know if that was helpful or not. Certainly ping me if you want more of an explanation, or if you have any other follow-up questions or concerns. We have many, many new things to launch in the next 60 days and people to introduce to you. And the second half of the year will be filled with meetings with a lot of you and kind of resyncing up on the second half and beyond plan. We've seen many life changes happen in the last, call it 2 or 3 quarters. So we'll be reaching out and looking forward to chatting with you over obviously the next 4 to 6 weeks, but certainly post summer. We'll be reaching out to many of you to have a little sit down, either via Zoom or in person, and we look forward to that. So hope that helps. I think there's, there will be blue skies ahead, but for the moment, we'll stay in the center of the teeter-totter. So cheers, everyone. Talk to you soon. Bye.